All right. Hello, everyone. We are so excited to be here today. We are very honored that IMES asked us to be part of this presentation. Hope you all are having a great day, and we can't wait until maybe in another year where we can do all of this in person. My name is Carrie Freeburg. I'm VP of Annuity Products at SILAC Insurance Company. I am joined today with some very special guests from one of our key partners, Barclays. Today, we have Eli Krauklis with us, as well as Alex Haas with us as well. We have an economic outlook to run through with you all today, followed up with just a little bit of information on the Atlas Index that we have with Barclays. And then I'll finish us up with some information on Atlas interest credits that we're seeing right now, as well as how dynamic the Atlas Index was during a very tumultuous and volatile year that we had here in 2020. So to start off, I'm going to introduce our first speaker. Eli is a vice president at Barclays. He's responsible for the U.S. equity strategy and U.S. small and mid-cap strategy at Barclays. We're very excited to get to hear his experience today. So with that, Eli, I'm going to go ahead and turn it over to you. Thank you.
Thanks, Carrie. As Carrie said, I am a VP of U.S. Equity Strategy at Barclays, and kind of what I'm going to do today is give a brief overview of what our expectations are for U.S. equity markets in 2021, a little bit talking about recent developments with the Georgia Senate runoff, what our initial expectations were prior to that, kind of the positive catalyst, negative catalyst, and then a little bit of just kind of where we see the S&P 500 at the end of the year and what type of sectors we think will do well and what won't, but that'll be very brief. So as I mentioned, just as pretty much what I just said, we'll talk about the Georgia Senate runoffs and how they've kind of reinforced our view of a healthy recovery for U.S. equities in 2021. There's three main positive catalysts besides the Georgia Senate that we saw as being kind of instrumental for equities to do well in 2021. And obviously there's a big headwind, I'm sure you can guess what it is, that we'll talk about it as well. And then we'll briefly talk about how we come to, we have a price target for the S&P 500, 4,000, which is really at this point, only about 5% higher, but the market has run very quickly since then, in the last month. And then lastly, we can talk about kind of which sectors we think will do well, which won't. So the big takeaway of what's happened in the last week is that because it's looking now likely that there will be a Democratic Senate, that means that Democrats will have the Senate, the House, as well as the presidency. So they kind of have a clear path for much higher pandemic stimulus. Now, this has already been kind of discussed previously. There's been some news articles talking about it today. It was leaked, but the expectation is that the Biden administration will try to pass an additional stimulus beyond what has been passed in December with the $900 billion. All right. So the main difference that we see in this additional stimulus is not only will it be larger in our expectation, but it's also going to focus on a lot of things that were major points of contention in the original stimulus discussions: state and local government aid, size of the stimulus checks, we say school, budget to help school reopening, vaccine distribution. All these things are going to be much easier to pass with the Democratic Senate, but it's still probably the most bipartisan support any of Biden's policies will get. So this is something that is going to be very helpful for equities, and it's something we expect to happen almost immediately. And I think that's why you're going to see that reflected in stock prices, in the last week, especially stocks that are more exposed to kind of a better, stronger economy, cyclical stocks. So another aspect, there's a couple more policy proposals by Biden that are on the table that have increased, the probabilities increased because of a potential Democratic Senate. The one we think is second most likely that'll happen after pandemic stimulus is clean energy infrastructure spending. Now, this is, even though a lot of money will go to it, from a U.S. equity, from a stock perspective, this is kind of a very specific thing. It's really, really going to help, electric vehicle companies, clean energy companies, solar companies, and it'll probably harm traditional energy companies, oil, coal, things of that nature. But for your, just regular run-of-the-mill, target or something to that extent, it's probably not going to have that much of an impact. Well, we think that, this should probably garner pretty significant Republican opposition. And, it can be passed, but it would need to be passed via budget reconciliation. But it would probably wait till after additional pandemic stimulus. We think this is pretty probable. And, so it's something to look for after pandemic stimulus. Now, the third thing people discuss is an increase in the corporate tax rate. So, in 2017, the Tax Cut and Jobs Act lowered the corporate tax rate in the United States from 35% to 21%. That's kind of your top line reduction. So one of Biden's policy proposals was to increase it back halfway from 21 to 28. So this we view as pretty unlikely. Firstly, because it would garner a lot of Republican opposition, a significant amount. Secondly, raising taxes of any sort in a fragile economic environment is kind of politically unpalatable. Excuse me. So we think it's pretty unlikely. And one of the things, the way we kind of track how likely these policies are to pass, we've constructed portfolios of securities that reflect these policies, and there are companies that do well if the policy passes or should do well in our minds, and then it goes short companies that will do badly. So we have a clean energy basket that's long clean energy stocks, short, traditional energy. That, as you can see right here, was going up all the month of December as if you looked at any sort of like predicted or probability of a Democratic Senate, was going up, and it had a nice little spike on the day of the Georgia runoff. Now, in contrast, we have also a tax hike long short. This is maybe a little less intuitive, but it's really long companies that wouldn't be hurt too much by a corporate tax rate, but short companies that would be really hurt by an increase in corporate taxes. Now, that fell pretty sharply, and that's been going down really all since the election. And, we really thought that this was kind of something that wouldn't happen unless there was a significant blue wave, where you had a strong increase in Democratic seats in the House, as well as, just an overwhelming win in the Senate. So we think it's unlikely for there to be a corporate tax hike in the near future. So getting back to, that's kind of the near-term stuff, the recent stuff that's occurred. But even before all this happened, in our view, we were optimistic on 2021, and we kind of thought there were three main catalysts. And one was, even though there's been a lot of opposition, and obviously not opposition, but contention around the results of the U.S. presidential election, looking at prediction markets by the morning after the election date, prediction markets said 90% chance Biden is president. And looking at the market's return overnight, what we saw the market wanted is it wanted a lack of ambiguity. So when the predictions were very close, when it was 50% Biden, 50% Trump, the markets had a lot of volatility. But as soon as it kind of went a little bit more clear-cut, there's going to be a clear-cut winner, the market went up. So even though there's been a lot of contention, the market really the whole time has just been like, okay, this is a done deal as far as the U.S. presidential election. The other main aspect, another main catalyst is, there's been a pretty significant amount of economic and earnings surprise in 2020 that isn't really being transferred into 2021 yet, and we think that is an oversight. So what I mean by that is that in March and April, the expectations for 2020 were really bad. Earnings were expected to completely crater. GDP was expected at one point to be down, I think 5% for the year, if not more. Now, what's happened since then is that there's been a pretty strong surprise, upside surprise in corporate earning growth for 2020, as well as GDP expectations. Corporate earnings, S&P 500 earnings have been surprising to the upside 20%, which is a historically strong surprise. I mean, it's the strongest surprise we've seen since the financial crisis in 2009. So because of that, go to the next slide. So there's been a lot of surprise, but what's interesting is that the numbers for 2021, which is this green line, so this is the expected growth in earnings in 2021 relative to 2019. You don't need to look at these right now, but this is just really what 2021 is shaping up to be. It hasn't changed at all. And we think that's actually pretty surprising. I mean, if you're consistently seeing strong earnings surprises and just significantly better earnings than expected in 2020, but for 2021 not to move at all, we think that that is just something where it hasn't really fed into those expectations yet. And we think that gap is going to narrow to the extent where you're going to start to see some better upside surprises and stronger expectations for earning in 2021. And so that's going to be a strong catalyst. And the other thing that lends credence to that is that, there's been really strong increase in expectations for the U.S. economy. U.S. GDP forecasts, like I said before, have all been trending up. So Q2 was very bad, trended up a little bit, but Q3 2020 went from down 7% to ending at -3. Q4 2020 went down to 5%. It's basically -2. And you're looking at Q1 2021. At one point, it was down 5%, and now it's nearly flat. So GDP is expected to be significantly stronger, but earnings are not. And so we think there's a disconnect there that's really going to help S&P 500 and corporate earnings to excel in 2021. So the third thing, and I don't need to go through the entire details here, is the vaccine, as everyone knows, the vaccine efficacy that we're seeing now is much better than expected. And the reason why that's so important is that a higher vaccine efficacy allows you to get to herd immunity faster. So with initial projections, we were thinking mid to late 2021 to the point where we would get to herd immunity. Now, as has been discussed recently, there have been some issues with the rollout. There's been some issues with, different mutation profiles of the COVID-19. But at this point, because the efficacy was so strong, so much stronger than expected, these rollout headwinds and mutation headwinds haven't really offset just how strong the efficacy was. But they're clearly headwinds, and especially because cases have been rising. So, as long as coronavirus cases here we can see are at, new all-time highs, deaths within the U.S. are all-time highs too, even though they're closer to where levels were in March. That's still a major headwind. If it takes time for the vaccine to get rolled out and that rollout is slowed, but cases are rising, you can see stronger lockdowns, which you've already seen in the UK. That's a big issue from a kind of economic standpoint, but there's a big aspect, I think, that sometimes people aren't really looking or overlooking a little bit, where companies and even individuals have so much cash right now. So for S&P 500 companies, what they did in 2020, they essentially issued record levels of debt. So this is an S&P 500, excluding financials, amount of debt, net debt issued. It's seasonally adjusted. This is just record level, absolute record level of debt. But then what happened is they didn't increase their spending on CapEx. They lowered their spending on buybacks. They lowered their spending on dividends. So where did the money go? Well, the money just went to cash. So if we look here, basically this shows that S&P 500 companies year over year through the first quarter in Q3, built up an extra $500 billion in cash. And that's a lot of money to act as a buffer if there's any additional economic or COVID-related or slowdown in vaccine rollout type headwinds. Now, individuals have been doing the same. Government spending, government transfers are up a ton, but so is savings. So there's a lot of cash sitting there where companies issued a lot of debt at very cheap interest rates, and they have a lot of cash sitting around. And individuals have been saving a lot of this money too. So even if there is a economic soft patch, as we'll call it, we believe the market will look beyond it because we have all of these cash buffers. So in our view, kind of the current view we have of I guess, third wave, or the competing pressures of rising coronavirus cases and the vaccine rollout, is that best case scenario, you have a similar wave to what happened in August, where you had a brief spike, things stabilized and pulled back, right? And there might be limited lockdowns to control the virus, but that's it. That's best case. But even if there's a significant drop in economic activity, right, companies do have a lot of cash and individuals have a lot of cash to hold them over, right? And even beyond that, we think from what we're seeing and what the market has been doing, as long as vaccine news flow remains moderately positive, we think the market will look through this economic soft patch. Now, if the vaccine rollout becomes very bad or something, or there's an unforeseen event with that, then yes, that could be a significant headwind that could derail the market. But right now, as long as it remains positive on measure, then it should be fine. So the other aspect we're seeing that's like kind of the last catalyst is just what are individuals, investors thinking? What are funds thinking? And this is, go over this briefly. But really, all these emphasize is that, during the course of 2020, you had a lot of fund flows, money going into funds and out of funds that were going out of funds. But all of that has turned at the end of the year. Total stock funds globally is up a lot. U.S. funds are up a lot. ETFs are up a lot. Mutual funds are still seeing partial outflows, but they're much better than when they were before, even though ETFs are significantly higher. Much better than they were in March. So flows are looking good, funds are getting more money, and retail investors are very optimistic. Measures of retail sentiment, there's a bullish bearish indicator we like to look at, is very strong. Retail investors are buying a lot of equities, and that's interesting because typically retail investors kind of are contrarian. They buy equities more when the market goes down, but in bought into the market rally. So there's a lot of retail buying pressure that's helping this market. So our kind of view right there, that was our qualitative overview of the positive and negative catalysts. Just to really briefly go into the actual numbers for the S&P 500 in 2021. Don't want to go too much detail into these exact numbers, but really what we're expecting is for a pretty strong earnings rebound, stronger than what analyst consensus is right now. So we're expecting earnings to rebound about 22%, right, after being down about 15% in 2020. And we expect that that's around 5% higher. It says 3 here, but consensus recently updated, or it's gone down a little bit. It's right now about 5% higher than what the consensus is. So we're a little bit more bullish on earnings. But, and I was going to say, the way we come to it, a little bit of detail, we basically have a macro model that we take those expectations for GDP and inflation and interest rates and everything else in 2021 and use that to project earnings growth. And then we also have what we call our bottom-up model, which takes analyst consensus. There's all the analysts out there that they have a price target or EPS target for Apple, Target, and Amazon. We take those and adjust them for analyst biases based on where we are in the business cycle. Analysts are a little too optimistic when things are bad, and they're a little too pessimistic when things are good. So we're adjusting for the business cycle. And the thing is, both these models are coming to right around 22%. And if we look at these over the long term, that type of rebound is strong, but it's not nearly as strong as the rebound in earnings we saw in 2010 after the financial crisis. It's stronger than what we saw during the tech crash and rebound, but it's more in line with maybe the early 90s rebound. And that is kind of a function of the fact that right now, earnings are much better than originally expected for 2020. At one point, there was the expectation that earnings would fall 30%. And so before GDP would fall 5-6%. Now earnings are expected to fall 15%. GDP is expected to fall 3.5%. So because of that, you're getting this really, because of that, the rebound isn't as strong because the base isn't as low. So even though we're very optimistic on earnings, kind of the thing everyone's talking about too is valuations are very high and prices are very high because valuations are high. And so we agree with that. Whether you look at valuations for stocks based on their current earnings or the earnings 1 year ahead or the earnings 2 years ahead, valuations look very extended. And we actually have a model that creates a fair value estimate of valuations based on current inflation volatility, current industrial production and economic growth, as well as the U.S. Treasury rates, the 10-year. And that's calling for a pretty significant contraction, significant contraction in valuation. So because of that, what we're really seeing as a summary is earnings is going to get much better. Earnings are going to get much better. Valuations are going to pull back. And as a result, U.S. equities are going to go up, around 5%. And that's sounds about right. So it's optimistic. They're already at all-time highs. So further growth is good. And that's where we are right now. So lastly, just kind of briefly, I want to give a little bit of overview to what we think about sectors. And this will be a very brief overview. But in general, the way we look at the sectors for 2021 is that we believe there's going to be a strong cyclical recovery in earnings. Commonly, people are now referring to this as the reinflation trade. And because of that, we think kind of sectors such as industrials will be strongly overweight. Industrials are really going to benefit from the cyclical recovery. They're going to benefit from the rebound in global trade and manufacturing, right? And they actually have a lot of stocks that have been really negatively affected by high coronavirus exposure. So because of that, and the expectation is things get better, they'll normalize. Healthcare should do well because there's a lot of healthcare investment right now. It's gone through the roof. And the FDA approval process is now very accommodative. Hardware and semiconductors should do very well for the same kind of cyclical recovery reasons as industrials. But they have an additional catalyst in the sense that there's really kind of a significant build out of public and private cloud infrastructure now that there's the expectation that so many additional people will be working from home, right? So this kind of cloud build out that we've seen in the last couple of years accelerating has just been, basically dialed up to 11. On the flip side, for companies we think won't do well, there's a lot of consumer staples companies that have done very well, like Target and Walmart, as things have gone to lockdown because they've been one of the few places that have stayed open to allow for people to buy kind of their staple goods. And if people are at home more often, they're going to need more of these staples goods. As things reopen, that should kind of reverse, and it should be a headwind for them. But similarly, communication services, if we remove, typically what we'll do is we'll remove the Facebook, Apple, Amazon, Netflix, Microsoft, and Google because they're kind of in a league of their own. They basically act very different. Amazon is kind of a consumer discretionary company, but it's just kind of its own thing. So communication services, cable companies, legacy TV, everyone moving to the internet, advertising moving to the internet, very harmful for them. We think that trend will continue. And lastly, utilities and real estate are kind of going to struggle because rates are expected to remain range bound, right? But if anywhere, they're going to go up, which will harm them, but we don't expect them to go up a lot. And there's going to be a significant drop in occupancy rates for offices as more people work from home, which will affect utilities earnings. So that's kind of our broad view for the sector. So really just in summary, we view that, the S&P 500, U.S. equities should do well in 2021. There's three main catalysts for it, I guess four now because of the Georgia runoff. We think that, the kind of, obviously not the lack of ambiguity, but now the initial lack of ambiguity from the U.S. election really helped equities. The vaccine efficacy has really helped them, as well as the potential for significant earnings surprises is the third thing that's helped them. Now, because you have more pandemic stimulus on the horizon from the results of the Georgia Senate runoff, it's really kind of pushing equities up. We think they'll have room for another 5% growth additionally, but that seems limited, but that's only because they've ran so far now. I think a lot of the returns we were expecting to happen over 2021 have been pulled forward. So, at this point, that's all to say. I'll turn things back over to Carrie.
Perfect. Thank you so much, Eli. One of the things that it's just been a joy for me to get to work with Barclays over the last year is that they're so smart, but you have these just extremely smart experts in their field, and they're able to talk about it in a way that we can follow and understand and use the information. So really, really appreciate that. One question that came to my mind, Eli, is this is great news about kind of the outlook for the US economy. And one of the questions I kind of had as we think about the Atlas index that we have with you all, that's a global index, is there kind of a similar global optimism as well with the global markets? Like we kind of think that'll follow as well? Or are you kind of seeing more that the US economy is set up right now to really have this market optimism for 2021?
So what I would say is, based on what I've seen from our European equity strategy as well as our global equity strategy teams, the vaccine rollout and the strong efficacy of the vaccine is really going to be the major positive catalyst globally. So you have a lot of, strong positive, and you've seen it recently in the UK and the EU, strong returns. And it really is from this positive vaccine news. And another aspect, I can't comment directly on, whether I think Europe will do better than the United States. But another thing to remember is that the U.S. did exceptionally well in 2020 because it had these really, really high-tech weights of these companies that just did exceedingly well during the coronavirus lockdowns. Amazon, Facebook, Google, especially Amazon. That's not really present in Europe. They're a lot more financials focused. So, a lot of, there isn't a lot of other countries that have this, Amazon, Facebook, Apple, that'll be 20% of their index. So they lagged a little bit then, but kind of the cyclical recovery really helps them because they're more, they have more traditional weights in financials and industrials, that's where you're seeing now with the better news from the vaccine, the better chances of a cyclical recovery, the better sense of the reflation trade, they'll get help too. So I would agree. It's definitely a positive catalyst. Really, really, really everywhere. And so I think it's not just specific to the U.S.
Perfect. Thank you so much. So now I'm going to turn it over to Alex from Barclays as well. So Alex is a director at Barclays. He manages the coverage for Barclays cross-asset sales insurance team. And a big thing that we want you all to know is that Alex is a resource for you. One of the very unique things about Barclays is that they have a team that is set up to work with you all as you have questions on the index. Obviously here at SILAC, we're ready to help you all at any point and at any time, but also, you have access to Alex. You can call him and ask questions and make sure that you really understand how, the Atlas index works, for example, too. So Alex, I'll turn it over to you.
Thank you, Carrie, for the introduction. I've been at Barclays for 14 years in sales, and like Carrie mentioned, I'm your liaison for all things Atlas. I live and breathe this. So I wanted to give everyone just a quick update because we're in a new year, and I wanted to mention how this performed in 2020 and a quick outlook for 2021. So I'm happy to say in a very volatile year of 2020, think about it, a vol target index like Atlas, it has a constant volatility of 5%. That's actually very hard to maintain in March when the coronavirus first reached here. Things were raging. If you recall, the S&P and the Dow were moving up or down 8 or 9% a day. Volatility was actually in the 70% range. So it's very hard to do anything in something like that. The S&P 500 was down 20% in Q1. The Atlas index was down 3.5%. So it did what it needed to do in Q1. As you know, this is a multi-asset index. It uses ETFs in stocks and bonds, and it avoided a big drawdown in Q1, which really helped it for the rest of the year. As you know, the stock market really recovered the last 9 months of the year, and so did Atlas. So I'm looking at statistics right here. Atlas finished the year up 7.5%. To put that into context, the S&P was up 16% for the year. But you can't compare this to S&P. You would want to compare this return to capped S&P participation. That's what you would get if you had exposure to S&P. It would be capped at 3 or 4 or 5%. So a 7.5% return is really good in the context of S&P would be capped out at 3 or 4 or 5%. In terms of competitor indices, the JP Morgan Efficiente index that's in Symmetra's product, that was up 2.25%. The BNP Multi-Asset Diversified 5 index that's in Athene's product was up 3.3%. I'm not cherry picking indices. I'm picking other ones that are based on modern portfolio theory, which is diversification across stocks and bonds. The Goldman Sachs Momentum Builder index that Lafayette Integrity Life have was down 1.38%, and the JP Morgan Mosaic Index that many people are familiar with nationwide was down 2.34% in 2020. And lastly, the S&P branded low vol risk control index 5. So I would consider that like the closest benchmark to Atlas. Atlas is a 5 vol index. You can't compare it to the S&P 500 main index. You got to compare it to the S&P 5 vol index. Well, the S&P low vol 5% risk control index was up less than 1%. It was up 89 basis points. And Atlas was up 7.5%. So you could say it outperformed its benchmark by over 6%. And this is after 2019, Atlas was up 11.28%. So it's been on quite a run in terms of performance. In terms of allocation, this is a multi-asset index. It's currently mainly invested in 3 types of equities. It's US tech, Japan equities, and emerging market equities. In terms of bonds right now, it's mainly invested in the US Treasury 5 and 10-year, as well as 10-year German bonds. So that's most of it, and it is fairly, the exposure level is pretty high right now. It's at 146%. So especially in an annuity contract where it's principal protected, there's only upside. It's a good thing to have it pretty high on the exposure. So that's kind of the point I wanted to make. It was a very good 2020. And I think a couple of drivers why were just really the kind of the index construction behind Atlas, which is 2 things. It's modern portfolio theory, which means diversify across stocks and bonds. And on top of that, there's a treasury momentum signal. It really helped that this index has a high exposure to treasuries in 2020 because a bunch of you on this call, follow interest rates and bonds fairly closely. And what happened in the first quarter when that S&P went down 20%, like I mentioned? Well, treasury prices went through the roof. Bond yields went down. So it really helped that this index has a really big exposure to treasuries in Q1, and it helped to have that exposure in US tech and emerging markets for the rest of the year. So 2021, Barclays, Eli, and the equity strategy team are calling for S&P to, our target is 4,000, so a little more upside from here, 5-ish%. And, on the interest rate side, our rate strategists are calling for, interest rates to go up a little bit as they should, but not catastrophically. So that's a fairly benign environment for something like Atlas that is invested in both stocks and bonds, for bond yields to go up very slowly and to have kind of a slight rise in equities. That should be contract, good positioning within an annuity contract. So I just want to reiterate what Carrie said. I'm your resource for all questions about this. You can reach me directly by calling the helpline. I'm going to give you that number twice. It's 212-526-3773. Again, 212-526-3773. That's our hotline for all questions about Atlas. It used to go to my desk in New York. Now it forwards to my cell phone. As you can see from behind me, I'm working from home. So you can speak to me directly if you have any questions about Atlas. If you prefer to email, my email address is first name, which is Alexander.Haugh, that's Haugh, at Barclays.com, Barclays. Again, Alexander.Haugh, Haugh, at Barclays.com. Back to Carrie.
Perfect. Thank you so much, Alex. So, all right, so we've kind of heard the economic outlook. Now we've heard more specific information about the Atlas Index and the performance that we saw from it. And really the last thing we're going to do, and then we'll get out of your hair and you guys can move on with your day, is kind of try to drill into, Alex mentioned how volatile, how tumultuous that 20% drop was and what was going on in February and March. And we're going to drill into that period of time and see how Atlas moved, how it pivoted in order to generate this really strong performance that we saw that not a lot of other indexes that are in our industry were able to capture during 2020. So one of the key things, we are not drilling into all of the details of the Atlas Index, but what we're going to talk about is how it can move, and it can actually move in and out of its different equity and bond components on a daily basis. So we're going to drill down into that, but to start, we're going to share a video that kind of walks you visually through the different parts of the world where Atlas goes. So the Atlas Index, every single day, it goes to all of these different parts of the world. And it goes there not based on someone's gut feeling. It really goes there based on the algorithms behind the scenes with the index construction, indicating where there's positive momentum, and it can realign itself accordingly and quickly. So we're going to now take a look at what that quick response can mean. And we're going to actually walk through a couple weeks of when COVID was really starting to hit our economies. And we're going to start with the week of February 21st, and we're going to look at where Atlas was. I kind of call this time, Eli might disagree with me, I call this kind of the calm before the storm a little bit, okay? We're still kind of waiting to see what this is all going to mean. And some of the news articles that we were seeing at the time, what a number of economists were thinking was, is this virus going to really stay insulated in Asia, or is it going to move beyond those borders? And there were a lot of questions at that time, if it does stay isolated to Asia, are the other economies in the world insulated enough that we can continue to see growth when some of this was going on in one part of the world, et cetera? So at this point in time, Atlas was 3% of it was allocated to China and to emerging markets, 8% to Asia, 31% in Europe, and 57% in the US economy. And it was actually a pretty good split between equities and bonds. So it was pretty well diversified with different parts of the world, as well as the equities and bonds. And at that point in time, 2020 year-to-date performance, this is just 1/1 through February 21st, the S&P was up a little bit, 331, and the Atlas index was up about the same, 342, okay? Now we're going to just move 1 week into the future. And at this point, we knew that the virus was expanding beyond Asia. We knew it was taking hold of Europe. First deaths outside of Asia. And it was also this week that the US started getting ready and asked Congress, for some funds to start getting ready for it. So within 1 week, Atlas moved away from emerging markets. It decreased its exposure to Japan, decreased exposure to Europe, and moved hot and heavy into the US economy. 82% of it was allocated to the US economy. And it started moving into those bonds that Alex mentioned, that those bonds were very, very helpful. At this point, the S&P switched to negative. It just was up 3% within 1 week. It had a loss of more than 8%. The Atlas index was no longer at 342, but it still stayed positive and had an increase of 92 basis points year to date. Again, 1 more week. I remember I was traveling. I was in like a different city just about every day during this week. And this is when things started getting a little bit crazier than they had been, I guess. We started having more travel restrictions. All sorts of restrictions were being announced. We had our first death here in the US. And at this point, the Atlas index moved away a little bit more from Japan, moved away from Europe even more, went into the US economy even more, and even more into bonds. S&P down 8%. The Atlas index, with those changes, the Atlas index actually grew. Instead of being at 92 basis point, it was now up to 221. Again, 1 more week, more and more restrictions. But we had one piece of news, and during this week was when China announced their economic reopening plan. So one of the big things we've learned over and over as we've watched Atlas over the last year is that we have a global economy for sure, but that does not mean that everything happens at the same time everywhere in the world. So here we're getting shut down more and more, while China is starting their plans. It was very cautious, it was very phased, but their plans for reopening. So the Atlas index, it's slight, but it actually moved a little bit back into emerging markets. It moved more into Japan. It moved more into Europe, and it moved away from the US economy this week. And here the S&P was down 16%. Atlas did flip to being a negative, but it was a slight negative. And as many of you know, who know our products here at SILAC, we have this interesting annual point-to-point with a boost strategy where we actually have an increase to the index performance, and that increase could have actually overcome that slight loss there. So now I'm fast forwarding all the way to the end of 2020, and here's where Atlas stands as of last week. So we had 79% of it allocated to the US economy, 10% Europe, 5% emerging markets, and 6% into Japan and Asia. And again, every country is kind of at different phases, right? But we see that Atlas is getting to more parts of the world at this point and has, a fair share in equities as well. So as Alex mentioned, for the 1-year performance for 2020, the Atlas index was up 7.51%. Now, I'm going to translate that to you to interest credits, right? That's what our clients are getting is interest credits. And really, the Atlas Index is a fantastic index that we believe in. We are so excited to partner with Barclays on this index because of the index itself. But that's not all. A key component to what your clients get is what is that adjustment that is tied to that index. And one of the things we're very proud of at SILAC is that we have great option budgets, great caps, great par rates, okay? So we have this great underlying index, and now we have adjustments like an annual point-to-point with a participation rate of 140%. So what we have clients getting interest credits right now is you take that 7.5 and you actually take 140% of that, and those are the interest credits people are getting. A year like 2020, and people are getting 10.5% interest credits. And then we have this boost strategy. So what happens with this is we take that index performance and we add on our Denali 14 product, we add 1.75% to it. So if you take 751, you add 175, you get an interest credit of 926 there. Now, I'm not saying this is always going to be the case by any means, but I'm saying that these are actual credits people are getting right now when they allocated to Atlas a year ago. So we are excited about that. This just goes through those dates we have looked at, and then it just associates if we were doing interest credits on these dates, you know, what those would have looked like. And you see, again, such a volatile period of time, and you are seeing, you know, just positive for the most part across the board, positive interest credits for these periods of time that we're looking at. And we actually even have some pieces now that we have actual interest credits people are getting from Atlas. We actually have some actual pieces for that to help you all as well. So we didn't dive deep into it today. We really wanted to give you guys the outlook, the economic outlook, give you a little bit of information now that we're at the 1-year anniversary of the Atlas Index being live and being available on SILAC products. We are so thankful, you know, that you had us all come today. We hope you have a great rest of your summit. And we're around if anyone has any questions, so please reach out. And Eli and Alex, thank you so much for helping out today. And IMS, you know, just a great partnership. You all are working with a tremendous partner here with IMS, and we just look forward to see where our partnership goes in the future. So thank you. Have a good day.